Welcome, everyone. My guest today is Lead Analyst Logan Mohtashami to talk about the big miss on the jobs report and what it means for Powell, rate cuts, and mortgage rates going forward. We have so much to talk about, but first I want to thank our sponsor, Optimal Blue, for making this episode possible. Logan, welcome back to the podcast, and we are doing a special Jobs Friday podcast.
You know what's interesting about this week? For those of you that have listened to our by the way, the award-winning podcast having us now 4 times a week. Do you see how valuable that was? Eventually, yes. I'll break you down for the 5th one. But in any case, people accuse me of knowing the report because of what we've said the last 2 podcasts about, the private payrolls are slowing down. Fed's ignoring that. They're going to run on the unemployment rate. The unemployment rate might not go up as high as it should have because of the labor force growth. And it's not the best position when you're not a neutral policy. So, of course, Friday morning, 73,000 headline jobs print. That's probably going to get revised lower too.
When we were expecting 100,000, right? People were expecting
100, but it's also the main thing is that these were the worst revisions I've ever seen in my life, because I was born in 1975, and in 1973, if I take COVID out of the equation, most people should take COVID data out of the equation, this was the biggest negative revisions in history since 1973, I think 253,000. If I do a 3-month average, it's 35,000 now.
Ooh, wow.
Old, slow. Who do I see on TV this morning? Beth Hammack. Beth Hammack, who we have talked about many times, the lady who says, the Fed president of Cleveland Fed, who said, oh, we'll play catch up. She says, oh, this is one report. No, it's not. It is not one report. You would be fired as an analyst if you said that. It is the revisions. It is a trend that has been here for 19 months. It is the personal consumption expenditure data going negative. What are you people looking at? Sorry, I had to get that out.
It's good to get it out of your system. I know it's been.
I sat there and I watched her on Bloomberg, and I said, she did not say that. And we've picked on her. We said she's going to be the one this year.
Is she the one that said we'll just play catch up?
We'll play catch up. I don't know what's happening, but we'll play catch up. And she said, oh, this is just one report. No, it's not. No, it's not one report. It's a negative revisions. It's a trend. So in any case, 10-year yield waterfall diet. So that 435 level was holding until, if we break below 435, where Fed policy is, the market is telling you the Fed is behind the curve on this. So, but sticking to economic cycles, right? What do we want to teach economic cycles, because if an educated class of people know how to read data, then they don't get suckered by fanatics. The residential construction labor that we have harped on, we said we keep an eye on here. If this is not breaking, you're not going to get a recession. Now with the negative revisions, 4 straight months of decline. And one of the things I've always said is that the Fed tends to ignore this. When this ever happens, they tend to ignore it, and then they go, oh, what happened? I will do whatever I can physically to make sure the Fed does not ignore it this time. I've seen this happen in other cycles. I am no way are they ignoring this one. So I even tweeted this out this morning. I said, homies, this is now falling. Housing starts and permits have been in a recession for many years now. Completed units are up to levels that we have seen post 1960s, where the builders go, oh boy, and they got a huge backlog. I'm like, So thankfully, the long end of the market does its thing, right? Remember, the bond market always leads the Fed. The Feds play catch up. But this is not like the last few times where the Gandalf line, I could say, hey, listen, this is not breaking. If Hodor was here, I'm like, boy, I'm losing the residential construction's claims would be the next stage F. So this is a little bit different than the last few years where I make sure to kind of hold the line. So it's not fun and games anymore. You know what Trump should do? Trump should have me just debate Powell live on air. Not only that, bring me his top Fed staffer data miners and let's go at it, because you can't, it's just one of these frustrating things. I'm not Trump where I want 3% rate cuts to emergency rates, no. But you should have been a neutral. I'm just sticking to my old policy. Going back to 2022, we said the Fed is going to do something that's going to piss a lot of people off. They are going to wait until the labor market breaks.
Yep.
Because they're old and slow. And then they're going to go, okay, we can do this. So now, if I went back in time, if I went back 3 months and those negative revisions were there, you would have had 7 dissents for rate cuts in the last meeting. So we're at that stage. Now, we've always had bad reports, positive reports, beat reports, whatever, but it's the trend that matters. And it's not just the labor data, the private payrolls. We've been highlighting the private payrolls for, oh my God, even the last month. The frustrating thing was, we talked about this last month. We said, if it wasn't for federal workers, we'd be talking, oh my, the labor market's getting really softer. But this whole month was wasted because of one government jobs print out here. So hopefully, Jerome, Neil Kashkari, Austin Goolsbee, Lori Logan, Beth Hammock, the Fed presidents, you are no longer the data miner kings and queens of this nation. Logan Mohtashami and his crew will challenge you because this looks like we need to be closer to neutral policy. And neutral policy will still be above the growth rate of inflation. But now we're here. This is what we're dealing with now.
You said in your article today about, we're recording this on Jobs Friday, obviously. You said in your article about it that, like, if they had had this information, if they had had this jobs report in hand just a few days ago, right? Before they met, they could have, you think for sure they would have cut rates.
I don't trust Powell anymore, but I'm sure there would have been more dissents.
Okay.
Because it is quite difficult to have 3-month average of 35,000 K, and now residential is breaking. See, you got to get these people in debates, and you got to show them, because what Trump is doing, Trump's bully ball tactics. And by the way, we talked about this yesterday. Trump should announce Fed Chairman Christopher Waller this afternoon. Stop wasting time. Every day that goes by, you're wasting time. Get this party started. You have all the cover in the world. You have the greatest cover in the world to do this, and nobody will doubt you on this now.
He did come out today and he called Powell names and said he has to cut rates right now. And if he didn't, he would have the board do something. And
Sarah, what would I do right now?
You would make sure I would go on the podium
right now and go, I am nominating Chris Waller as the next Fed chairman. He is the shadow Fed president until Jerome Powell leaves his post. I would end this construction, whatever this stuff is. And I go, listen to this man. This homie's leaving. This man is the future. He is the past. That's what I would do right now. But I'm not the president. So I'm just like, I'm trying to be as respectful as possible here, because we understand the BLS data, there's underfunding, there's a lot of stuff going on, and it's a very tricky cycle. But we have models in the past, and we go back to 2022 when Jerome Powell went on TV and said, we would like the Fed funds rate to marry 3, 6, 12-month core PCE. This is not asking rates to go below inflation or on par with inflation, but get it toward a neutral policy so we don't have to worry about residential construction workers losing jobs in the four months. And you do not, under any circumstance, want residential construction workers and manufacturing jobs being lost at the same time. That's the death nail.
And we
of
had
economic
manufacturing
cycles right
jobs in
there.
this,
You can
correct?
have a manufacturing recession. We had that in 2015 and 16, no recession. We had manufacturing jobs lost last year, no recession. Now you're just playing with fire you don't need to. It's just like, old and slow, labor over inflation. I hate it. I hate it. I knew this day would come. And you didn't need to do this. You could have just got a little bit lower and move. Now, thankfully, on the positive side, mortgage rates are below 6.64 today. So we are officially in that starting range of rates where in the past things get better. When rates get towards 6%, the builders get happier, right? And but the demand picks up a little bit. Then they start, okay, we can build homes, right? So as always, thankfully, the long end of the market, which matters, is going to do a lot of the early work for them. And next time, if rates get down to 6%, Lord have mercy, if you have another Fed president come out and say, people are buying homes again. I don't know. Oh my God, they're going to have sex and they're going to buy stuff from IKEA. How are we supposed to rebalance it? No. If you don't want this job, go fishing. Go to Cancun.
Go fishing.
Go to Alaska.
That's right. Don't go to the Love Island for economists. Like
a lot of people were asking, Chart Daddy Love Island.
Oh my
That's
gosh.
going to be the next reality show.
Let me just tell you the comments. I knew it was going to be unhinged, and I was right. Okay, so I have a question about the revisions, because this is something that is confusing to the layperson, and there is already a huge conspiracy that the government is somehow manipulating the data. So how do you get revisions this big? How are you off that much in May and June?
So let's talk about what did we see in the data that was concerning to us. We saw the consumption data start to slow down. Now, what happens?
Are you talking about in those
for the first half of 2025? Okay. Right, the PCE consumption data. It's actually really rare. I did a video of it on Instagram stories. That was getting really nerdy to me because I don't think anybody's ever seen that data line. In any case, the private payrolls have been slowing down for some time now, and housing starts. I mean, we've always highlighted this. It is very rare to have an economic expansion when housing permits are in a recession. That does not occur. So the total units being completed, right? This was the whole supply and demand equilibrium argument we made in December of 2024, that the builders are in trouble here unless rates go lower. I mean, how many articles did we write in the last 5 months about this?
Yep.
But when we talk about negative revisions, we're like $400 trillion a country. We're like the wealthiest. I always say maybe Cleopatra, adjusting to inflation, had more or just the same amount of wealth as the U.S. But our government data trackers are not being funded. Thank you, Doge. We've had revisions this big before, but it's 1973. What happens with surveys, if you do not have the capacity to run proper surveys, you're going to get nasty revisions, both up and down. So if I was Trump, I'm just, putting money back. You got all this tariff money. Put some into the BLS. Make sure you can get the data correctly. And then maybe you could get your lower rates faster than you want. In any case, what happens always is you're going to see tons of negative revisions, because what happens is the following year, you get the tax data to confirm about these jobs. So you can have revisions out to 5 years. We always used to show this chart where you see these positive revisions and negative revisions going back decades. So it's not uncommon to get revisions. But here, I care about the trend. The trend has been slowing down for some time. The consumption data that the Fed held their hats on has been slowing. So I was like, okay, homie, come on. What are y'all doing? So, but I mean, on a positive side, that boy, Jerome's going to have a hard time. I mean, I could not have thought of a worst jobs report for him than this, because of the negative revisions, because he says housing's weak. There's not going to be enough supply no matter what. We don't give a about that. Housing's weak. Housing starts going to recession. Residential construction workers lose jobs. That's a first level labor trigger for every recession we have seen in recent modern day history outside of COVID. So it's just, I can change them. I can change them. Get me to the federal, let me take their data miners and we could run correct, proper models to talk about this stuff, right? Because it shouldn't be that difficult. Y'all got a lot of cities out there. The Fed cities follow me. I know the staffers are listening. Reverse your old model trends to update to the current equilibrium of housing data. Come on. It's not that difficult. Okay, I'm pleading myself to the people who I know are listening to this. There's no reason to even be in this position.
They should be listening to you, Logan. Of course they should. Okay, so you talked about how the 10-year yield's down today. Mortgage rates are down below 6.64%. What does this mean for September rate cuts? What do you think could actually happen now?
So now this becomes interesting because we're going to have another jobs report. We're going to have, one of the things we always said is that the Fed really, really weighs jobless claims data, because if I'm to believe I'm correct that the Fed's going to wait till the labor market breaks, then jobless claims is always going to be their key. But now they have an early labor trigger that really gets ahead of the jobless claims breaking data line. So, of course, September rate cuts are in play, but now is this going to be a repeat of last year that we get 0.5% cut? And then the Federal Reserve a year from next year and says, oh, well, we waited too long, just like they did last year. Literally, we might have that same thing. They could have cut and then they wait till September and they cut. But now it's a little bit different because the curve is lower and the Fed funds rate could get to a lower base. So it's one of these things to where, as you could all see, the bond market cares more about the labor data, right? And we talked about this week, that even with a hawkish Fed and all these things happening, the growth rate of goods inflation picking up, the bond market really didn't break up higher. But here it's just a waterfall dive. So my best advice to all the Fed presidents, somebody get some media help for Beth Hammack. My God, you cannot literally come on TV and say, this is just one report. No, it isn't. It's the revisions. It's the consumption data. You do not have the luxury of being disconnected this much anymore. All right. So we need those media help people. What are they? Those like whenever a celebrity does something stupid, they always get like,
right.
We need something like that, just to you don't need to lose the cycle. Just get to neutral.
So,
right.
What are the chances that, just like last year, bond market gets ahead of the Fed? We see, 4 to 6 weeks of more demand, purchase applications pick up. The Fed goes ahead and lowers rates, and mortgage rates go up, just like last year.
The difference is that the Fed funds rate was much higher back then.
Okay.
So the 0.5% cut was playing catch up. When the Fed says they're playing catch up and they're too late, is that 380 was too low. 450 was about right. So this is why I always say 435 to 470 looks right. But you get rate cuts where the 10-year yield is now hypothetical. Let's just say the 10-year yield is at the Gandalf line at 3.37. Okay. And if the Fed cuts and then all of a sudden the data gets better, the 10-year yield should move up toward 4%. I'm just, we're getting to the point to it's easier to get down to 4% on the 10-year yield and stay there and not be shocked with data. So again, the counter to everything is that the economy reaccelerates and the growth rate of inflation, right? The whole case of, we made that whole podcast just like what can happen for the no Fed rate cuts at all this year. The economy has to outperform. The labor market has to outperform. The labor market can't deteriorate because the Fed has a dual mandate. Their mandate does not care. We wrote that, was it 3 months ago, 2 months ago for Trump? Stop talking about net interest payments. That's not what the Federal Reserve does. That's not part of their mandate. That's the Congress didn't even dedicate them to do that. So net interest cost is not what they care about. Inflation and labor, right? So if the labor market is deteriorating, they can do this. So at least this is a whole different backdrop now, because what happened last year, always remember this, everyone. We had a 2% rate move lower with no rate cuts, but the 10-year yield was well ahead of the Federal Reserve. So the Fed cutting 0.5% was still like, they could have cut another 0.5% the next meeting, and the 10-year yield was still well below that. So we're in a much more balanced spot to where the Fed funds rate is and the 10-year yield now. If the 10-year yield was at 360, that's a different conversation, but it's not. It's like the last I saw is 423. So we can save them. Sarah Wheeler, we can save the Federal Reserve from making this common mistake they have done over the past. So
they should listen to you and our housing market, our housing market peeps. They need this, because if there's no reason for this, if this is what should actually happen, I mean, at the same time, you're suppressing the housing market and you're suppressing people who want to buy homes, and all the good things that happen after people buy homes.
When we talk about economic cycles in housing, it's really residential, it's housing construction, and usually in an expansion, permits are rising, not declining. They've been declining for a very long time. So they've ignored it for 3 years now. They've ignored it. Now that residential construction workers are losing their jobs, they can't ignore it anymore, because this is where I've been here before, and you see this, it's happening, and they go, well, the general economy, no. So I'm hopefully Jerome and everyone, Jackson Hole's the next time that they're going to have a Fed talk. Hopefully there'll be some more of a discussion. But if Trump really wanted to do something, and forget these tweets or Truth Socials. By the way, I got back on Truth Social again.
Oh yeah, they reinstated you.
I said on my Instagram stories that I got banned because there's a fake Logan Mohtashami, and then the Truth Social follows my Instagram story. So then the guy said, "Hey, texts me and says, hey, I got you back on." I was like, "Oh, okay." The Truth Social posts against Powell are not an effective measure, but you have a plan in place. Bissett created that plan for you to pull the trigger when you need it. You have the greatest cover in the world to do this now. Take the shot, right? Don't hold back. Be Trump. Be over the top Trump. This is a time where you can be over the top Trump, and you'll get people to back you up on this. But man, what a week. What a week, Sarah Wheeler.
A week.
This is like the Super Bowl for nerds. I'm loving it. So much excitement. But man, I just saw those revisions and the residential. I was like, oh.
I know. Well, Logan, thank you so much for coming on this bonus episode. We had to do it extra. We're putting this out on Saturday just because this was such a huge jobs report for everybody in housing, looking at mortgage rates and what could happen. So thank you for being on, and thank you for giving great advice to the Fed, to the president, to all the people we know are listening.
Sarah, pleasure. And as we said on July the 1st, the second half of 2025 is going to be lit. Popcorn, everything.
We did not know how much.
Let the chart daddy cook, because this is going to get even more fun later on.
Thank you. Bye.